Hi, I'm Jesse Baines with Yahoo Finance Canada. Welcome back to Editor's Edition. Today we're talking about real estate during COVID-19, which obviously has been hit hard, right? Wrong. We're on track to have its busiest year ever during a pandemic at that. That's all been quite the head scratcher. So I'm so glad we have our guests to help make sense of it all. In Toronto, we have Velocity Realty's John Pasalis. Hey, John, thanks so much for being here. It must be a boo.
Yeah, absolutely. And thanks for having me again. I think these monthly calls are definitely a great way to recap what's going on in the market.
Yeah, I mean, we've been getting lots of great feedback. The viewers are enjoying it. So thank you. All the way across the country, thanks to technology, we have Oakwyn Realty's Steve Saretsky in Vancouver, who's probably been equally busy in his part of the country.
Still going. So, keep them busy and trying to keep safe too. So thanks for having me on.
Thanks for being here. Today, we're going to get into all kinds of juicy topics, including mortgages, the condo market, this so-called urban exodus. But let's start with the Bank of Canada and its role in the recent rally. Bank of Canada Deputy Governor Carolyn Wilkins made some comments about housing just a couple of days after we last talked. Have a listen.
Monetary policy is contributing to the strength in the housing sector, as monetary policy should. That's how monetary policy works. The financial concern would be whether or not the mortgages that were being taken on were not affordable in the long run, in the sense that the loan relative to the income was just getting too high. And we've talked about that in the past. Now, where you look at the particular strength in the housing market, it's in areas like Ottawa and Halifax and Montreal where the loan to income ratios are pretty low relative to the rest of the country. The other thing that we're watching closely is looking at, well, are we seeing shades of what we saw in 2016, where in particular urban centers like Toronto and Vancouver, there was a lot of speculation and price growth was reflecting what we thought were extrapolative expectations. And of course, right now, we're not seeing any of that. In fact, what we expect is that rebound, to the extent it reflected pent-up demand, will ease off a bit.
Okay, so John, let's start with what she said about monetary policy, about its role in the housing. Your mind when you hear that?
I mean, she's absolutely right. I mean, one of the goals of monetary policy is to help our economy recover during recessions and to support the economy through slightly lower rates. So she's 100% right. But I do agree. I don't think it's having the impact a lot of people think it is. I mean, I think it's popular to kind of blame the bank for what's going on in the housing market. The reality is, it's not having as big of an impact as I think people think, and that's largely because of the stress test. So even though the Bank of Canada lowered their policy rate significantly by 1.5 percentage points, at the end of the day, people are borrowing based on an interest rate of 4.8% because that's the mortgage qualifying rate. So it's not about in qualifying for mortgages, assuming we're paying 1.8%, which is what we are. We're qualifying at a much higher rate, and because of that, it's not sort of fueling the type of the housing bubble that maybe we would have the stress test in place.
And Steve, what's your view on the monetary policy angle?
I'm going to push back on John a little bit, but
good. I love it. Bring it on.
Looking at the Bank of Canada's very metrics on residential mortgage credit growth on a year-over-year basis, it's the latest reading, I think, is for September. It's growing close to 6% on a year-over-year basis, which is pretty much at levels we saw pre-stress test, which when we saw the housing market taking it off and mortgage credit growth accelerating, I think part of the reason why the stress test was brought in was to slow that growth in credit and to slow the frothiness that was building in the housing market. And so here we are today, fast forward during a recession/pandemic, and you have residential mortgage credit growth accelerating to levels that we last saw during the stress test. So I think it's clearly having an impact. It's clearly compelling people to go out there and borrow money, particularly on, let's say, an insured mortgage. You're borrowing a 5-year mortgage today at 1.5%. I mean, I think that, again, if the Bank of Canada's objective is to maybe restart the economy, housing being a key component of the economy, then I would say job well done. Obviously, I think there will be repercussions for that down the road.
And we're seeing fixed mortgage rates creep up slightly, Steve, on positive vaccine news. Do you expect the Bank of Canada to let rates creep up? I know they signaled they're not raising their overnight rate for, I believe, 3 years. But do you expect them to take their foot off the gas a little bit in terms of asset purchases going forward now? Steve?
I think that, yeah, I mean, I think there's been some pushback clearly from in the political space. So we saw the Bank of Canada come out and curtail their purchases. I think instead of $5 billion per week in QE, they're now saying we'll do $4 billion, but we're actually going to do, we're going to do, we're going to focus those purchases on the longer part of the yield curve, which they said, quote unquote, was to more directly influence the cost at which households are borrowing at. And so that clearly tells me that they're trying to influence, 5-year fixed rates probably to keep those rates low. So I don't think that the economy has the ability to withstand higher mortgage rates or higher interest rates in general. And so I think the Bank of Canada, if yields start to tick up higher than they like, I could easily see them coming in with some sort of yield curve control, which is, again, it's in plain sight. They've already talked about it publicly.
John, your turn to push back on Steve, if you want to.
Yeah, I mean, I agree in the sense that I don't see long-term rates going up anytime soon. But the reality is, I think our economy can handle higher rates. I mean, I don't know if I agree with Steve entirely. I mean, at the end of the day, yes, I mean, I think having interest rates in the high to mid 1% is driving demand, as it should be. I mean, that's the whole point of monetary policy. I mean, monetary policy isn't there to tank our market when it's already struggling. It's there to drive the economy. But at the end of the day, anyone who's getting a mortgage at 1.5% is qualifying, assuming their interest rate is 4.8, right? And I think that's not a small thing. That's a significant thing. And again, I think these are part of these, macro-prudential policies that were put in place to make sure, that our economy, our banking system is stable. So again, people are qualifying at 3 full percentage points, over 300 basis points more than what they're actually paying today. So that's not to say that we're going to see higher rates. Like I don't think anyone in the Bank of Canada or the federal government wants higher rates anytime soon, and they made it clear they're not. But I don't think our economy or our housing markets is vulnerable, I think, as a lot of people think, because people are qualifying at much higher rates than they're actually paying.
Do you think, John, that the stress test makes sense in its current form still? I mean, there's been talks and plans of overhauling it, but what's your view of what the stress test should look like in the current environment?
Yeah, so I mean, one of the changes that they were planning on putting in place, which they rolled back, was actually basing the qualifying rate at around, I believe it was 200 basis points above what the average interest rate that people were actually going to be paying on their mortgage. And the idea with this is that, it effectively would have been significantly lower than it is today. I don't think there's any needs to roll that back, because when you have such strong demand, even at this higher qualifying rate, I don't think there's any real need to actually lower it significantly right now. I mean, arguably, it's just going to fuel more demand for housing. And, when prices are rising in the double digits in a lot of cities in Canada, do you need that stimulus? And I think had our housing market struggled and demand had been slow and prices weren't rising, they probably would have floated that a little bit more and lowered the mortgage qualifying rate. But my instinct is just the strong demand in houses and prices kind of pushed them to not go ahead with that change as they were planning to. Okay,
great. So I do want to talk about mortgages a little bit more, but let's just before we do that, talk about another point that she raised. She said, Carolyn Wilkins, in that clip, she said that the loan to income ratios in parts of the market that are doing well are okay for her. She's comfortable with, the bank's comfortable with where they are. Do you get the same sense, John, in places like Ottawa where prices have been going crazy? Do you get the sense that she's right there?
Yeah, I think she is right. And that, again, I think really comes down to the stress test, right? So at the end of the day, people are borrowing assuming their interest rate is 4.8%, but they're really paying, say, 1.8%. So at the end of the day, when you look at the debt that their people are taking on and their actual mortgage payment, it's significant. Like the debt to income is significantly lower than it would have been had we been qualifying at an interest rate at 1.8%. You know, our debt to income would have been significantly higher. So I think she is right, and I think that's just all a byproduct of the stress test right now.
And Steve, prices are, it's not like Toronto's cheap, but prices, the average price is higher in Vancouver. The sense that the loan to income ratios are at a level that we should be comfortable with in the Vancouver area, or the parts of the market that are really strong right now.
Certainly not in Vancouver. I think that there's obviously, I think that gets highlighted, you know, all across the social media landscape of Vancouver having some of the highest, you know, prices to income ratios in the world. So people earning an income here are certainly taking on, are basically forced to take on a lot of leverage. So I think the debt to income ratios in Vancouver are well beyond repair. Certainly across, you know, other parts of Canada, like as she mentioned, Ottawa and Montreal. Obviously, there hasn't been as much house price appreciation in those markets over the past 5 to 10 years, and now it seems like they're starting to play a little bit of catch up. So yeah, I suspect that those debt to income ratios there are much more healthy, but in Vancouver, there's certainly a lot of leverage here.
And Steve, let's talk about the type of mortgages that people are taking on. Is it more insured versus uninsured? Are people coming with big down payments, or just the bare minimum just to get a foot in the market right now?
Well, I think the problem is in Vancouver. You know, our home prices are so high that there's really not. I mean, unless you're going out to the suburbs, there's not a whole lot you can purchase under $1 million in the city of Vancouver. So, you know, even if you put down, let's say 15% or 10% on a, you know, $800,000 home in Vancouver, you know, your mortgage payments are so high because you're looking at a 25-year amortization. So what we tend to see is a lot of people trying to get to that 20% down payment, trying to go the 30-year amortization route through an uninsured mortgage. So that seems to be the most typical play in Vancouver anyways.
What about you, John? What type of mortgages are your clients taking on, or that you're hearing about in Toronto or the Toronto area, the GTA?
Yeah, I mean, probably very similar. I mean, certainly we're seeing a lot of uninsured mortgages. Again, I think a lot of that's really driven in the Toronto area. You know, a lot of people who are getting into the market, even if they're first-time buyers, I mean, they're getting in through just capital, generational capital, basically, just parents passing down, you know, hundreds of thousands of dollars now. I mean, it used to be tens of thousands to their kids to help them buy a home. And this is really what's kind of pushing people above that 20%. And I think that's just, I think to Steve's point, that's kind of more the trend. People trying to get over 20%, go with 30-year mortgages to keep their costs a little bit more manageable.
And John, finally, you know, we've spent a lot of time talking about Carolyn Wilkins here, but finally, she said that she's not seeing shades of 2016. Are you, John?
Yeah, I mean, so she's referring to, at least in the Toronto area, when we had a really rapid speculative bubble in 2016, people buying properties as investments. I'm not seeing that quite yet. I mean, a lot of the demand we're seeing, at least in the Toronto area, is really driven by end users. Having said that, I don't know if that's going to stay the case. Again, I mean, one of the side effects of low rates of 1.10 is that it starts looking very attractive as an investor. I mean, even if you're qualifying at a higher rate, investing in real estate is a lot more attractive with rates that low. So I would not be surprised if in the new year we do see, you know, stronger demand from investors in the housing market for sure.
Yeah, I mean, like you talk about the rates, I did a story and we compared Vancouver house prices at the higher level that they're at now compared to last year. And because of the lower rates, people are actually paying less in mortgage. So I guess there is that feeling that, well, my mortgage is less, even though the price is higher. Maybe I can carry that mortgage as long as I need to. Anyways, I'm just talking to myself here. But Steve, what's your feeling? Are you seeing shades of 2016?
So I think it's a bit of a mixed bag, because John brings up a good point, and it's similar in Vancouver as appears to be in Toronto, is that we don't have the same sort of speculation in the terms of that you have a whole bunch of investors driving the market, people speculating on pre-sale condos, people buying one-bedroom condos to rent out and extrapolating higher rents. And so we don't really have that kind of speculative fever in the market. But what I would say is that we do have shades of 2016 in the terms that you have pretty rapid price appreciation early in single-family homes. I wrote in my report there in October, 30%. So 30% of single-family homes in Greater Vancouver sold above the asking price in the month of October. That's the highest percentage for any month that we've seen going back to last time we saw that was back in 2017 during the spring market of 2017. So people are that what that tells me is basically, we're seeing a lot of multiple offers. We're seeing bidding wars that's driving prices up above the asking price, and we're seeing rampant price appreciation. So that has shades of 2016.
Okay, so nationally, it was another record month for October. Let's take a look at the numbers. Sales year over year up 32.1% in October. The average price up 10.9%. That's coming off the busiest month ever in September. It was a 0.7% decline, something like that. But Korea says it could be the busiest year ever. Do you think we're on track for that to happen, John?
I very possible. I mean, I haven't looked at to see if we're as peak as we were. I think the 2017 or 2016 were the peak years, but we're definitely having an incredibly strong year in the GTA, and I think a lot of this is again the October stats are again this COVID spillover of the market freezing in March, April, May, and people just rushing back into the market, and again a lot of new buyers jumping into the market, which again was not something everyone predicted, but it is this demand for low-rise single-family homes, at least in the Toronto area, that's pushing the sales growth. I mean, for November, condo sales are probably going to be flat compared to next year. So all the growth's really coming from low-rise single-family homes and predominantly in the suburbs.
Okay, Steve, if you have to look at your crystal ball, I didn't bring my crystal ball from episode 1 today, but do you think we're going to get there? Do you think this is going to be the busiest year ever?
I think in Vancouver we'll probably fall short of 2016 levels. But it will be very close. I mean, I know for a lot of people, personally, that they were having record years. A lot of the realtors here in our office, myself, I talked to my mortgage broker. She's been 25 years at RBC. She's a top producer at RBC, and she says, I've never been busier. This is my busiest year ever. So certainly not something we would have anticipated back in April when the entire economy was shut down and everybody, myself included, CMHC, were anticipating lower prices and a depressed housing market. So I guess we'll wait and see when the numbers shape up at the end of December, but certainly it is turning a lot of heads.
Right. Okay, let's zoom in on that was the national picture, but let's zoom in a little bit more on your specific markets. John, you were right last time we talked about another strong month for October. Sales were up 25%. The average price up 10%. The average selling price even more because of the move into higher priced homes. The party has to have ended in November.
November, no, it's not ending in November. We're going to see very similar trends in November. Sales are still going to be up double digits. In the suburbs, sales are up well over 30% in the suburbs. If we look at single family homes, we're not going to see that as an average because condos are pretty much flat. In City of Toronto, single family home sales are around 15% or so up. But we're going to still see strong growth in sales and in prices for sure.
Okay, sounds like somebody's vacuuming, but we'll wait. Okay, there we go. Steve, where your face-ripping rally call is playing out so far. Let's take a look at the REBGV October numbers. Up 34.7%, price up 6%. November's, it's done in November, right? Or even December. Let's look out a little bit. Are we going to slow down anytime?
Yeah, I got killed on social media for that comment. But at the end of the day, I'm trying to take my opinions out of it and just looking at the data. The data is pointing to me is to activity levels. Everybody wants to jump on the condo market and say, well, the condo market's kind of, not doing as great. If you look at it, condo sales in October, I mean, it was the busiest month since 2009 for Vancouver apartment sales. Yes, the only thing that was kind of counterbalancing that was that new listings surged to record highs, and that ultimately put inventory up higher. So overall, I mean, sales activity levels are extremely strong, and I don't really see I'm not having any sort of forecast for higher mortgage rates. I'm looking forward and saying, okay, we've had this level of activity. Everyone said, okay, well, it was pent up demand. And I said, yeah, okay, maybe it was pent up demand. But here we are, and we're 6 or 7 months now into this, post lockdown scenario. At what point does 6 or 7 months of data start? When does that narrative change from pent up demand to next, housing bull market? So I'm looking forward and saying, okay, well, now we're starting to get vaccine coming out. Let's say that starts getting distributed in Q1 2021. We're entering into the spring market. The labor market's going to get a little bit better. The optimism is going to get a little bit better. We're going to have immigration coming back. Population growth has been stalled out. I just don't. For me, I look at that and say, well, that to me looks like it's shaping up where you could see a ton of activity next year continue through, because you have the momentum at your back. The Bank of Canada says, don't worry, we've got your back. We won't raise rates until 2023. To me, I think it could potentially play out that way.
Okay. So, John, that urban exodus that we've been talking about, how's that going now that, has everybody exited yet? Like, if you were going to leave the city, have you left? Has everybody gone, or are people still trying to get out?
I still think we're seeing a little bit. I think most people have sort of made those quick moves, but it's not over. Again, if it was over, suburban home sales would not be surging by 30 to 40% year over year, right? So there's still demand in the 905 in Toronto suburbs. And we're still seeing people kind of move out of their downtown condos. And it's, the demand even for single family homes in Toronto is a little bit more sluggish compared to the suburbs. So I don't think it's over. I think that trend's continuing, and it'll probably continue into 2021. And I think Steve's point's a very good one. At what point does the pent up demand sort of roll over into a bull market? And yeah, if things start aggressive in the new year, which I probably think they will, it's no longer pent up demand at that point. We're kind of moving into a completely different market, and it's probably going to stay bullish for houses. I can't say the same for condos, especially downtown. It's a completely different market down there.
What about in Vancouver or in the surrounding areas? Or what's your view? Are people that were going to leave the city, have they already done so?
Yeah, so same sort of story. If you look at sales growth this year, sales growth has been the most robust by quite a long shot, actually, in areas of the suburbs. So we're looking, here that would be Langley, Abbotsford, Surrey. Those have recorded the highest percentage increase in the number of sales. As when you compare that to the city of Vancouver, particularly in the condo market, there's almost very little to no growth in the city, and so all the growth is actually coming out in the suburbs. It'll be interesting to see if that flips. When the vaccine comes and the economy reopens and people start going back, slowly to their offices, does the level of activity, start to reverse, and people will go, oh no, why did I just, I'm commuting an hour and a half a day now. Oops. I don't know, but I think it's certainly probable.
Okay, so Steve, you touched on that idea of like, what if you have to go back? Like with this vaccine talk, John, do you think people are starting to regret their decision? It seems like it's coming quicker than a lot of people thought, and offices eventually opening up again downtown.
It is a good question, and I'm actually hearing it more from, I guess, employers downtown who have been telling me, they're telling their staff, well, they need to start coming back to the office even 2-3 days a week, and they're getting a lot of pushback because, people don't want to be traveling, and they've already moved, and they're expecting to just work from home. So, yeah, I don't know. I don't know if there's a ton of regret yet, but I do think, once offices open up downtown again, we're not going to be working from home 5 days a week. Are we going to be back to the same level we were before? Probably not, but. Again, I don't think we're going to be kind of permanently working from home. And I do think a lot of the people who are expecting that to happen, are going to either, like Steve said, have a really long commute or just be forced to find a new job in their local communities, which is probably going to be a bit harder.
Yeah, speaking of local communities, I mean, the people that have moved out to Woodstock, Ingersoll, and that's in Ontario for anybody that's not heard of Woodstock, Ingersoll, but the prices are up 25% compared to last year. John, do you think that people in places like that are scratching their heads in amazement when these city folk are coming in and offering 25% more than they were for their houses? Are they like, what? What is the draw?
Yeah, I would think so. I mean, again, in a lot of these communities they're not even suburbs anymore. These are like really, really far from the city of Toronto downtown core that are seeing 25%. These are areas that do not see 25% year-over-year price growth. In most of these communities, homes don't get bidding wars. They sit on the market for months. It's a really slow market. So certainly for some of these areas, for people to see bidding wars, 10 people competing on homes and prices going up 20-25% in a single year, it's probably shocking to a lot of these people. And I do wonder if these areas are going to get hit a little bit in the future if they end up seeing a bit of an exodus back to the downtown core, because that rate of growth is not normal for those areas.
So now the other side of that, John, is the condo market. Last time we talked, the micro condos were struggling. Is that still the case?
Yeah, absolutely. I mean, very interesting. I did this analysis of how oversupplied downtown Toronto condos, or actually not downtown, the whole GTA is by square foot type. It was an analysis that Realtor in Toronto, Scott Ingram, did, which I kind of modeled across the GTA. And really, when we look at the data, it's really interesting because a year ago, smaller condos were the most competitive, which made sense. They're the cheapest. They're the ones that people get into the market with. And fast forward 1 year, and it's the micro condos that have the most inventory. And then the ones that have the tightest supply right now are actually around 1,200 square feet, which again makes sense. Those are the units that people can live in long term, a little bit more space, even if it's 2 income earners with a kid, it's enough space to live and work out of. And yeah, for sure, the micro condos across the GTA are the hardest hit right now and the most inventory.
Steve, I'm going to put you on the spot here. Is this a buying opportunity for the micro condos and the parts of the condo market that are under pressure?
I think in downtown Vancouver, I personally think it's oversold. I think that the sentiment is really bad. People really truly believe that the downtown core is dead, that it's just getting worse. There's no point in being downtown. You don't need to go to the office anymore. And I think that people are over extrapolating. Again, it's a recent phenomenon. Yes, it's a pandemic. We haven't seen one obviously in a long time, but it's been 7 or 8 months here of change. And I think that once we get a vaccine, again, that maybe life won't go back to fully normal. I think there'll be a lot of hybrid models in terms of working from home and going to the office, but I still think that the vast majority of people will be going into the office in some capacity. We have Amazon opening up 6,000 new jobs in core. They're building 2 new towers. And so I think people will be going back to work in the office, and I think that downtown will revive itself. And so I look at it and say, well, you're seeing double-digit price appreciation for homes way out in the suburbs, and you're seeing double-digit price declines in the downtown core. I think that's something that people can potentially capitalize on in terms of being a little bit of a contrarian play.
Now, to John, I'll ask you: do you think that, are you seeing developers looking outside of the core, condo developers anyways? Are you seeing new condo developments popping up outside of the core in ways that you hadn't before?
Yeah, I mean, there's just, what we're seeing from companies like Urban Nation, and we're hearing from them, is that the developers are starting to focus a little bit more on projects outside of the downtown core in the suburbs. And a lot of this is just driven by the fact that, the downtown core is the hardest hit right now. So prices are softening a little bit. Rents are down almost 20%. There's a lot of inventory. So as an investor, you're sort of looking, I mean, it's kind of a little bit silly because if you're investing, I mean, you're investing on what the market looks like 5 to 7 years from now, not what it is today. But today's pre-construction condo investors are just looking at today's market, and they see downtown sluggish, 905 is not as much. So they're focusing on suburbs because that market's been a little bit more resilient.
All right. Well, that's it. That's all the time, unfortunately, we have. Great conversation. Again, John, thanks so much. John Ellis of Real Estate Realty. Thanks for doing this.
Thanks for having me.
and Steve Saretsky of Oakland Realty. He's in Vancouver. Thanks, so you don't get into more trouble on social media.
Yeah, I'm in big trouble. Thanks, Jesse. That was a lot of fun.
Yeah, it was indeed. Thank you, everybody, for watching. It's been great tracking these markets over this unprecedented period. John and Steve will be back with us next month, and in the coming months to help make sense of it all. Meanwhile, keep checking back at Yahoo Finance Canada. We'll have all kinds of stories about real estate, the stock market, the economy, energy, you name it. Check it out. Thanks. Unprecedented period. John and Steve will be back with us next month, and in the coming months to help make sense of it all. Meanwhile, keep checking back at Yahoo Finance Canada. We'll have all kinds of stories about real estate, the stock market, the economy, energy, you name it. Check it out.